hard to follow that cool music. Hey, this is Dr. Tom Carr, aka Dr. Stoxx. Welcome to Market Talks with Dr. Stoxx for September 16th, 2013. This is a brief tutorial. We do this on a weekly basis where we look at the general market or we drill down and look at a specific stock. Today we're going to be looking at the S&P 500 and asking ourselves, is the current uptrend, which is today hitting new all-time highs, is it sustainable? So we'll look at that in just a moment, but first a quick disclaimer. I just want to let you know that everything that's said today is for educational purposes only and that no trading or investing advice is being given. I also want to invite you over to our new website, drstoxx.com. And you'll find there 3 daily stock pick letters with every closed trade listed in our performance section. And you'll also find a webinars, I should say, we're working on a number of them, trading manuals, and a managed account service. So let's look at the chart of the S&P 500. I actually have the proxy for it, the SPDR ETF SPY, which tracks the S&P 500, of course, and we are clearly in an uptrend of about 45 degrees if we were looking at an angle. So if we drew a line from left-hand corner to upper right-hand corner, that's, of course, a 45-degree angle, the hypotenuse of a square right triangle, and it looks like we're at about that same degree. So 45 degrees is the sweet spot of uptrends. Anything greater than that tends to peter out fairly quickly, and anything lower than that tends to break its lower trend line and turn over. So we're doing well from that perspective. Let's draw quickly a trend line underneath the lows. I always teach in our charting tutorials that when you're drawing in trend lines, in an uptrend you start with the lows, and a downtrend you start with the highs. So we have our primary line underneath the lows of this uptrend, and your secondary line goes over the highs, and you always want to draw that in parallel with the primary line, so it would look something like that. You can see that the most recent leg up prior to the current one didn't quite reach up to where it should be. It should be up here somewhere to touch that upper trend line. So we're seeing a little bit of lackluster momentum on the current uptrend, but we are in another leg up after a constructive pullback to the trend line, and that's always a good sign. Let's look at the MACD indicator to see what it might be telling us. One of the things I always look for in the MACD indicator is where are the major moves, the major legs up or down in a sustained trend. That's very easily seen on the MACD. You simply look for the highest highs or the lowest lows in a downtrend. And we're in an uptrend, so we're looking for the highest highs, which would make this movement right here in the month of May as the strongest leg up. During the month of May is when we saw the strongest price momentum, and on a percentage basis, on a price basis. And we normally expect then from that point on to see some constructive consolidative action, i.e. Flatline construction, flatline consolidation, or pullbacks of some sort. And as long as the uptrend is sustained, that is to say the lower trend line is not violated with a close below it on good volume, then we would consider that to be constructive action and a buyable opportunity whenever we do see a pullback into the lower edge of the trend. We got that in June. This actually was quite a strong thrust down. You can see the MACD indicator here in June dropped below its zero line, which is not something you want to see in an uptrend, but of course it does happen, particularly after such a strong leg up. If you're an Elliott wave theorist, you're looking at this wave down as a 4 wave and the next leg up as a 5 wave, and which means that the price indication that we're at now is something after that. Maybe a new leg up, maybe a new leg down, we just don't know. I'm not an Elliott theorist, so I'm going to pass on that analysis. The other thing we see from the MACD, which is not a surprising thing and not too concerning as far as the bull's case goes, is we're seeing some lower high action here, whereas price is putting in higher highs. We expect that after a solid, strong leg up, and we expect that especially at the tail end of an uptrend. And we certainly are in the tail end of this uptrend, which is the full of 2013. And we're also at the tail end, and tail end, I mean, it doesn't mean they're coming to an end, but it means that we've been in a fairly long uptrend since the recessionary low of March 2009. So I'm not too concerned here that we're seeing some lowering of the volatility, lowering of the momentum, as indicated in the MACD indicator. That's fairly normal, fairly typical, not anything to get too worried about. But it does make me very cautiously bullish going forward on the S&P 500 as a broader index of what the whole market will be doing. Now, those concerns are underlined when we scroll down to look at the volume, which I have here below the chart. The volume indicator, I have a 21-period exponential moving average overlaid. The volume indicator is showing me that at very important points, volume spiked way above average, and that's always a sign of institutional buying and selling activity. You really want to pay attention whenever volume gives you that sort of information, way above the moving average, because that tells us that institutions are at work. And whenever you see the volume bars pulling down way below the moving average, as they are here in July, that's also important information. That's telling us that institutionally, the big money traders, the hedge funds, the pension funds, and so on, the investment banks, they are not as active in the market. They're not as decisive about the market at that particular period of time. Now, you want to see that sort of low volume activity on pullbacks if you're bullish of the market, and you want to see the sorts of extreme volume spikes take place during the upswing. We're not seeing that from June to where we are today. We did see that back in May. We saw a few high volume spikes in April and May on the bullish upswing. But once we got into June, we saw a lot of this very bearish volume activity take place, which tells us that the institutional money traders were not real positive on the market and were running for the exits. And it doesn't necessarily mean they expect the market to roll over, that a bear market is on its way. It simply means that they're shifting their monies out of stocks into something safer as they look for an opportune time to get back in. And so that's where those huge volume spikes come from. That doesn't come from retail traders, trading their own personal accounts. You can't get that sort of a spike. You can only get that when the big money is going in and out. So clearly in June, big money was pulling out of the markets. And then we had this nice little float up here in July from left to right. That's a nice uptrend. But the volume is not confirming. Do you see that? How the volume really pulled down below the average. Now, in the summertime, of course, volume does lighten up a little bit, but July is still a fairly heavily traded month normally. August is the month where you expect to see some light volume. And so the fact that the market was moving up as volume was moving down was a concern. And so here in August, no one was surprised then to see the addition of a pullback. However, we did catch a nice support on the lower trend line. And that's always a good thing, and we're now bouncing nicely back up off of that. But I do want to point out, if we can zoom in a little bit closer here, that the volume in August is a concern going forward, because these big spikes here in volume, there's one, there's another, there's a third, there's a fourth. They all came on down volume, on down price days, on the days when the S&P 500 lost ground, and you don't want to see that. On a pullback, you want to see light volume, and on the upswing, you want to see heavy volume. We're seeing just the opposite right now. So there's some concern going forward that this new high top that we're seeing today, it's already a dark candle, which means the current selling price, the close hasn't quite happened yet, but we're almost there, is below the open, and that's never a real positive thing. It doesn't necessarily mean it's going to go down tomorrow, but the fact that we're seeing this lowered volume take place right in here, as the price is going up to new highs is a major concern. It just tells us that institutional money is not behind this move so much. So all of that is to say that going forward, we are bullish, but in a very cautious way. We would want to start taking some profits off the table. If we have open longs, consider selling some calls against them, and maybe even buying a couple of those inverse ETFs that will hedge your positions fairly easily over the next week or two. It doesn't mean we're going into a bear market, doesn't mean the uptrend is coming to an end. It doesn't mean we're even going to go down this week or next week. It simply means that the uptrend is vulnerable right here. So that's it for today. God bless everyone. See you over at drstoxx.com. And if you have any questions, please feel free to email me directly, drstoxx@drstoxx.com. Thank you.